All right, all right. Sorry, guys. I'm trying to get this lousy YouTube transition so it's a little smoother, and just delayed on this here. All right, we are officially live on YouTube now. We're live everywhere. Great to see those of you who are here in Zoom. Great to see those of you guys who are here on YouTube. Give me just one more second here. I'll pull up a chart. You guys can watch that. That'll keep everybody mesmerized for a second. I need to pull up the YouTube questions so we can see that, and then we'll talk a little bit about our plan for the day. All right. Let me get back to here. I want to be able to see our YouTube friends. We're platform agnostic. We do not discriminate against those on YouTube. All right, I believe I can see your questions. I'm going to say something. Hey, YouTube. All right, there we go. So spoiler alert here. I have spent a stupid amount of money on streaming gear so that we can hopefully improve the quality of these broadcasts and continue to deliver. I mean, the content's amazing. I mean, if we're just candid. But, you know, it's called the best-selling book, not the best written book. And I think that we've got the best written book for sure. And we need to upgrade the production quality so it's sexy and everybody wants to read the book. But I mean, with Scott Landers on the phone, can you really? I mean, I don't know how you get any better than that. I'm also realizing that my computer is not charging, so I'm going to kind of kick us off here, and then it has two ways it can charge. This is TMI, but it's supposed to charge when I plug in my monitor. And I don't want to unplug that to reset it, but I have a separate charging cable I can grab here, and I'll let you talk for a minute, Scott, when I grab that. But here's the outcomes, and Chris Burgess is joining us. Okay, he's logged in now. So you got the one and the only Stock Landers in the house, and of course the genius Chris Burgess. I thought Chris Burgess was young, but I just recently realized that he's not as young as I thought he was. So he just hides it well, and we're all jealous of him for that. And then my name is Josh Hesse. Glad to be here with you guys today. Let's start off having a conversation about the market, SPY in particular. And I want to share with you guys, since Scott was talking fibs last week, I sort of feel like he was stealing my thunder on that, because that's the area of the world that I've carved out for myself. Scott can have all the other genius things, but you know, hands off my fibs, Scott. No, I'm just kidding. I've learned a lot about fibs from Scott, and I'm really glad that he pointed out what he did. If you missed it last week, you should go back and watch the show. It's on YouTube, and just looking at some market levels from a larger time frame, from a monthly chart, and it was very insightful. But here's, if we drill in a little bit, this is interesting to me on a daily level. Now, in full disclosure, I have a bearish position that's open, probably on the verge, not probably, it's on the verge of getting stopped out now. So there's probably a little bit of hopeful, wishful thinking going on, which Scott will be sure to call out and tell me all the things that I've done wrong. But just imagine with me, if you will, this scenario. I'm going to clean this up a little bit. And for those that don't know fibs, you know, God love you. It's so much easier when you can understand fibs. So you should come talk to us here at TradeSmart University. We can help you figure that out. And it's about seeing the market in terms of typical movements. You know, Fibonacci analysis is based on the golden ratio, which the Pythagoreans figured out centuries ago. And as it turns out, there's this ratio in life, 61.8%, that we seem to be very comfortable with as humans. And the reason for that is it's all throughout anatomy, it's all throughout nature, it's all throughout music and things that we hear orally. And what was birthed out of that a few centuries after they discovered the golden ratio is the Fibonacci sequence, which basically says you take two numbers, add them together, and it gives you the next number of the sequence. So if you start with 0 and 1, 0 plus 1 equals 1. So then the sequence continues, 0, 1, 1. take the last two numbers, add them together. What do you get? 1 plus 1 is 2. The next number is 2. So 0, 1, 1, 2. You guys see the sequence. 2 plus 1 is 3. So 0, 1, 1, 2, 3, 5, 8, so on and so forth. And we can take those Fibonacci, that Fibonacci sequence, and turn them into ratios. And that ratio is the golden ratio. And if we just draw a simple fib on the chart here, focus on the green lines. I need my tablet working. Focus on the green lines here. This distance from that top black line to the bottom green line is the golden ratio, 61.8%. And then you wonder, well, what's the other green lines? Okay, well, spoiler alert. From the bottom to that upper green line is also 61.8%. Now, if you want to be super nerdy about this and measure the shorter distances here, that's 38.2%. Now, the line in the middle is not exactly a Fibonacci ratio. It's 50%. You can see it splits the difference exactly in between the start and the stop of this range, the two black lines. And we put it in there for some context. And it is shocking how often stocks will go to that 50% line and do something. It's a pivot point of sorts. But the lines that we're most interested in, well, we're interested in all three of them, but the Fibonacci lines are the 38.2%, the 61.8%. And then if you want to get super nerdy, you can start subdividing even more. You can, basically draw these same three lines in here, right? And all these ratios as well. I'm just taking from that green line down here and subdividing it with Fibonacci ratios. All those have extra numbers on top, which in my model world are not worth memorizing, because all we have to do with computer technology is come in and re-subdivide, and then you got new lines that are there. Some people like to stack a lot of Fibonacci lines on their chart. I don't think that's wise. I think at some level, if you get enough lines on your chart, then everything is bound to hit a line, but that's not helpful. It's interesting, but not helpful. Okay, so with that background, this is where I was headed with that. The adage that I have, we come down, we start heading up. Scott made a pretty good argument that there'd be a pivot here, and there was last week. Very insightful, Scott. Thank you for that. The question is, how do we know when we're like fully committed? Like, all right, we're gonna start reanalyzing some bullish trades here. Well, in my opinion, you start measuring these recent ranges and you draw your fibs on there, and then as long as we come to or within but not beyond those Fibonacci zones, then theoretically this thing can roll back over. It's not a confirmed short-term bullish market. So I got looking at this and I said, okay, so we're kind of popping up here. Let's just come back and measure this range. Where was I? Right here. Nope. Hold on. Everything I've thought about life is a lie. There we go. There's the top of this gap. This is why I mark my ranges with candlesticks. Gap analysis, if we have time at the end, we can get into that. But essentially, it's a coin toss. Is it at the bottom or the top of this gap? And then you start doing multiple measurements to ascertain which one is the better measurement. So from there to there, I'm specifically looking at this candle where we obviously made a turn down, and then this candle where we obviously made a turn up, and there's a green line. That's interesting, but not helpful yet until we start measuring a bunch of other things. What if we come back to, where was it? Right about there. This is the one I was looking at. Next major pivot down. So we come down, it retraces up. This candle, big, dark, gnarly candle, that's where the market made a decision it was heading lower. Now you start stacking Fibonacci ranges on top of each other. These two were easy to see. And then this one back here, that's why I did that second one first. This one was not quite as easy to see, but I think that it is still valid. Again, we could go with this candle. We could go with this candle here. I guess if we took the top one, it would be just about the same on the upper side, maybe a little bit beyond. But what I want you to start seeing is this cluster of Fibonacci lines that have gathered right there. I'm going to take off this last one just to make it a little bit cleaner for us to see. One Fibonacci retracement is interesting. 2 is significant. 3 is substantial. So I think what this orange line means right here, and that's where that confluence zone is, as long as we are trading up and bumping our heads into this, there's a good chance that we may see a pivot on down and test some of these levels here. Whether we continue on lower or not, I don't know. But here's what you need to watch out for. And I'll put a price on here. So it's 397.33. As soon as we break through this, there's a good chance we will come back and test it as support. And that's the money play right there. So I'm keeping a very close eye on this pivot. As soon as it breaks through, I probably won't go chase that. It could be it could be a gap and go, right? But it's probably going to come back, test old resistance as new support, and continue on. The other thing I want to point out, and then I'll toss the baton over to Scott to tell me all the things that he would correct. I say that tongue in cheek. He really doesn't do that to me. I don't know why I'm being weird about that today. Check it out. Momentum is starting to follow price action as well. Right, so we sort of had this wedge that was happening here. Is this a breakout or not? I don't know. I think we're on the last draw, but momentum is definitely starting in our favor. I was looking at RSI is the same way, and then there's MACD right here. MACD is starting up ever so slightly, but starting up, and certainly from these points here, momentum is in agreement with the lower highs. So we're starting to make we're starting to make higher highs and higher lows. We're seeing momentum coming into the equation. And then last but not least, there's a lot of talk about these 50 moving averages getting busted. The Qs, I think, went through it yesterday. Yeah, the Qs, I guess 2 days ago, it just barely closed above, and then has continued on. Look at these moving averages starting to turn over. So, I'm starting to seriously question my bearish position. It may get stopped out. It may, I'm hopeful, it may bump its head on some resistance here and give me some grace to get out here. At this point, I'll be happy with a break even, which is probably right around here is where my break even is on that position. But my stop is just above confluence there. And if we get out, and maybe this will tee up if we got time at the end, we can talk trading plans. But for me personally, I won't take another trade on SPY until we get another couple trades out of our belt, because this one's brutal. That'll end up being just over a 1 hour loss, and that's unusual for me to take that big of a loss on this account. So we'll just let it simmer for a minute and recoup and go and look at some other trades. I do have one trade that's just started triggering, but I'm going to let some others talk here for a minute and get Scott's perspective on this as well.
I just wanted to chime in real quick. If you guys are wondering like how Josh chooses which candles to draw from, because you'll notice he doesn't draw from, the top of the range to the very bottom of the range, the highs and the lows of the candles and all of that. Often he's picking a candle, 1 or 2 in, or he's looking for a gap or something like that. So if you guys are wondering exactly how he does that, he's got a course called Fibs in 4 that we teach at TSU, and it's all taught by Josh, and he'll walk you through exactly how he sets up all of those fib levels, where he starts from and how he draws them and what he's looking for.
Yes, everybody should take Fibs in 4. It's genius. Have you taken Fibs in 4, Scott?
No.
Okay. I mean, why would you could, you got me on speed dial. I'll do all the Fib analysis you need, my friend.
I appreciate that. Glad I'm here. Glad y'all are here. Thanks for everybody attending, whether you're regardless of where you're coming to us live from, or you're watching this in the future. So, interesting tidbit about Josh's position. I know lots of pros right now who are positioned just like Josh is, and who are underwater, unfortunately, like Josh is right now. Okay, so Josh is not alone in company of people that are short the market and feeling a lot of pressure right now. And I know this from professionals I know who are in the market involved right now, who are positioned just like Josh is. With that said, this chart here, if you know anything about me, you understand that I have a real strong belief in about unfilled gaps and major averages. Again, do not confuse this with individual equity names. There's a different mindset. We are chewing into an unfilled gap zone. So if we get through this unfilled gap zone, I've got you a channel on here. You can kind of get an idea of where this might run into trouble. One, the unfilled gap right over here, which is around whatever that low is, 404 and change. And the top of this channel is somewhere going to be in proximity to that. So that gives you something to play with. I've told Traction Pros heard this from me as well. What I hate about this is, let's go back to kind of Josh's bigger analysis, that we do run up and then we pull back, regardless of where on the chart from. You've got two unfilled gaps below. So I'm not big about giving time frames and horizons with stuff like this, because inevitably it's not going to work out like you want it to. But let's just pretend, you know, this over the next several weeks, as we get through July into maybe late August, somehow we do roll back over and we go back to the unfilled gaps. Not saying that's not going to happen, or it is going to happen. That's not my point. You've got two really solid targets below where to go to. Okay, you've got both those things. I'm leery about what I'm about to mention the marketplace, but if you haven't seen the headline this morning, President has COVID, right? Please recognize, how do I say this? I really don't want to get in a tangent here. I just want to make this really brief. Realize that that is a serious thing regardless, and the market is going to be fully aware of that. For any key leader in any country, I want to leave that there, because I really don't want to get any more in depth than that. I've got pro buddies of mine. This has always been an outlier conversation, is where I'll leave this part of the conversation. And so it does raise concerns for anybody with COVID, with health, and then the position of power this man is in. So market is going to be sensitive to little blurbs of that going forward. You see the unfilled gap overhead. We're trying to chew through this. The reason you care about unfilled gaps on major averages like the S&P 500, guys, is because there's really not a whole lot of people right there to get in the way of this thing trying to lift higher. We could have a news blurb again, some event, market comes down, but you at least know a target on the upside of this is what I'll address with that. One more thing I want to go to really quickly here. I can't use that chart. I'll just do this. I want to go to the daily on the S&P, and I want to add in, Josh had this showing and I should have made him keep it up there for a second. Just hang on. When it comes to indicators, everybody gets this or not, but let's at least touch on it for just a second here. Where did it go? Right there.
I just put the gap on my chart. What's interesting is that confluence zone is almost exactly 50% of the way into that previous unfilled gap.
Just the MACD on here, don't work with the Bollinger Bands and the price activity. Look at where MACD is relative to its zero line right now. Okay, this gets missed by a lot of pros I've known over my lifetime, and I mean pros as in floor traders, fund managers, all that. If you can think of this being when you are above the zero line and MACD is crossed over, think of that as being a double positive. And when you are crossed under the zero line, your yellow is below your blue here, a double negative. Does that mean you immediately go trade this? No. But to get back to Josh's point of where could we run into trouble? Well, when you get to that zero line, guys, that's kind of like, if you think of the football analogy on the field, just like that's midfield, right? Which side of that do you want to be on? Well, it depends on who you are, which team you are. Same thing here. The more that energy gets above that, the more it wants to get your attention, because you're going to see this like a weighting. So if you were to make like a little histogram of weighting, okay, the zero line above it, I'm bullish, below it, I'm bearish. If I get both lines above it, that's another level of bullishness. And so this does play into things. I also get a lot of times you'll get tops above that line. We get that. But just from a weighting standpoint, a momentum standpoint, it adds another layer to that. Don't ignore that, because it could also be we start to get in trouble as the MACD lines try to get up to that level a little bit and we start to struggle. Last thing I'm going to bring attention, same thing I've got on this chart here. When you start looking left, look over here. Price has memory. I say it all the time, look left. When you do, realize this is the consolidation. We basically fell roughly 5 deviations of that box down. We actually covered this in a YouTube live, I don't know, a month ago, whenever it was. And so, or however long ago it's been, somewhere back in June. If that's where we sold from in the past, what was support once broken becomes what? Future resistance over here. So that doesn't mean it has a stop there. But just like when you're driving your car, you come up to a traffic light, guys, and the light's red and there's a bunch of cars waiting at the red light. Are you going to keep going 80 miles an hour? Or are you going to slow down? You know, that's where you sold off in the past. Textbook 101 stuff right there. If it was support in the past, it's broken, it becomes resistance in the future. It doesn't have to hold it. The other thing is this, one more outlier piece just to be processing. Different people I know within the industry, some people seem to think the war in Ukraine and Russia will end sometime next month for a variety of reasons. Or with what you've heard this morning, I think Russia's pumping, what is it, nat gas or whatever is back to wherever it was, some headline like that. So people are not going to be cold and freezing and starving this winter, whatever. If the market, depending, and I've said this to the traction group, let's assume the market's up another, I don't know, 8% from here, and it's gone vertical up. And then the war news, let's say the war stops. It could be anticlimactic at that point. Versus if we were sitting off the lows, you get a 2,000 point rally. I still people who think if the war ends right now, we'll get a massive rally. If you see that headline comes out, you just have to look and see what the market's doing at that point in time. But it's just a heads up. These are those things that are weighing on the market that are out there. So just to be heads up aware of it. Does that help? I hope everybody.
I think it's so good. And what's interesting is it feels so volatile right now. But I was talking with Chris yesterday. The S&P, or the SPY in particular, is actually in a squeeze. And I would love for him to talk through that and the strategy that he's got developed around that whole thing. It's really interesting to see the volatility evaporate out of the market.
SPY is no longer a squeeze as of today so far. I mean, I suppose that could change if volatility dies down for the rest of today. I can try to show up, but my internet has been not very cooperative this morning. So let me give it a shot. Or maybe it would be better if you pull it up on yours, Josh, and I can just kind of walk through the pieces.
I'm wondering if I have a different setting because I'm still showing a squeeze on mine.
I'm not seeing on the Ttm Squeeze Indicator, but let me try just with the Bollinger Bands and Keltner chains.
Yeah, they've got some special sauce in there, I'm convinced.
Oh, I'm sure. Yeah, be good. Give me just a minute to get this.
I know we have a request to look at Tesla when we get a chance to, Chris.
Oh yeah, we'll do that. I see that in there, Johnny. Now, well, Chris is getting set up for that. Let me just explain a little bit of what you're seeing here. Go ahead.
Oh no, I mean we can just do it on your chart. I don't need to pull up the same thing.
Okay. Then go ahead. I didn't know if you were ready or if you were doing something else.
Sure. So the squeeze is basically just a moment in time volatility is compressed momentarily. So it basically happens when things quiet in the market. And the way that we quantify that is by using two different measures of volatility. So we use the Keltner channels, which measure average true range, and we use the Bollinger Bands, which measure standard deviation. And those are both just two different ways to measure volatility. And we quantify a squeeze by saying that the Keltner channels are outside of the Bollinger Band, or the Bollinger Bands are inside the Keltner channels, which means that our standard deviation is within our average true range. And this doesn't happen very often, but when it does happen, it generally tends to set up for an above average sized move in whether it's an equity or in this case, an index or a cryptocurrency or whatever it is. This works across many asset classes. Generally what happens is it's kind of like a quiet before the storm, or you can think of like a rubber band pulling back, right? It's quiet, it's kind of building the energy. And then once those Bollinger Bands expand back outside of the Keltner channels, then that energy tends to be released and there tends to be an above average move in that asset. So here we're seeing it on the S&P 500, which is unusual. We don't usually get a lot of these on the indexes, but it means that we could be in for some pretty volatile moves here in the index.
Yeah, your internet was cutting out a little bit, so I hope you guys caught all of that. Essentially, what Chris was saying is the light blue line, which is the Bollinger Band, when it's inside the orange line Keltner channel, it's showing an evaporation of the volatility. And so what we're looking for is a breakout. Now, there's an actual indicator in Thinkorswim called the Ttm Squeeze. And Chris was saying that, so you're saying it just had a breakout to the upside today on the Ttm Squeeze indicator?
Yeah, the Ttm Squeeze is saying that it fired today. On the actual Bollinger and Keltner channels, there's not. And I wonder if they set it up differently in their indicator using, for example, exponential instead of simple moving averages is one way that that might get a little bit different.
Yeah.
But I'm not sure because we don't have access to the code for the Ttm Squeeze, so we can't look inside and see exactly how they programmed it.
If you have, that's in Thinkorswim, right? It might also be in TradeStation too. It's called the Ttm Squeeze Indicator. I don't know if it's a paid. Yeah, I don't know if it's a paid add-on in TradeStation or not, but that is doing what you're seeing on the screen here. And if you want to learn how to read that indicator, it feels like a pitch fest for everybody's classes. But I think Chris gave a brilliant class on the squeezer strategy, and that would be a good thing to brush up on as well. But yeah, I mean, all roads are pointing to maybe we're seeing the end here. With all Scott's appropriate disclaimers that it doesn't have to be like 2008 where it was a V bottom. It could be a little bit rocky in here, but it also may not be. We may break through confluence and head on up. And what a great time to start loading up on shares of stocks that you were wanting to do a covered call strategy or something like that on, and just buy them at a discount. I mean, some of them are 30, 40, 50, 70% off right now. And you can snag 100 shares, just do them in groups of 100 and then start writing covered calls all the way on back up. So it's a cool time. And so I'm curious, Scott, if you have any opinion, because I'm of the belief, and I'm going to let you talk while I get my power cord, because I just realized it's about to go out. I just, some of it is what I read, briefings that I'm reading, and some early economic data coming out. And while, yes, maybe gas is coming down and maybe Q3 is starting to finally relax some of the financial pressure, the recession commentary is going to be based on what happened in Q2. And Q2 is pretty brutal. Like, I think it was worse than Q1. So, like, what do you think happens if it comes out and it's announced that we're in a recession? Is that just a non-starter in the market because they see through it? Or is that going to potentially cause some waves, do you think?
I think the market, some of the things I'm hearing and seeing, listening to, has a lot to do with yeah, we're good. So one of the things I keep hearing is if we could get a little grip on a little bit of idea about Russia as one piece, okay, maybe it's a big deal, maybe it's not. I don't want to make light of that in what's going on in Russia. I'm strictly from a market perspective, guys, okay? The more critical pieces, okay, really recession, okay, and where's the Fed? At what point is the Fed going to say, we've done enough, we're going to halt? Because of CapEx expenditure, people looking at investments. I've been on calls this morning related exactly to this and other avenues that I deal with. And, people were trying to gauge it. I knew going into end of Q3 last year, a scenario I'm dealing with for a friend of mine, and they were told by multiple investment business leaders that they were dealing with this specific thing. They said, we need to wait and see what happens in the next quarter. Well, then we go to the end of the year, we start beginning January, the market starts coming in. So they pushed out expenditures. So these things tend to fall, they tend to unwind, the dominoes start to fall. And so it becomes very, how do I say this? It becomes almost like self-fulfilling. And I think that's the disturbing part about it. Going back to Josh's, point, it's like, how is the market going to treat this? And so I'm going to show you guys a chart in this regard. Why am I not getting there? Hang on one second. There we go. Long-term, weekly. So when we start, if we continue to move up, I'm still inside this pink magenta looking, colored channel through here, right? And until we get through with that channel, nothing actually changes. It's not that we haven't had great support at the bottom of the channel. All this is all geometric structure stuff I teach them in traction, but we've had some really good, it's moving up, but does it really look like a bottom structure right now? And so you start factoring the macro is where I'm trying to get to. You factor in interest rates, the Fed, because the Fed's been the world's biggest hedge fund, and yet we know they're destroying demand intentionally. So there's this balancing act, and I don't frankly think anybody knows for certain. I mean, I know you don't want you guys hear that, but I'll be asked, hey, what do you think is going to happen in a week from now? And I shrugged my shoulders and said, I don't know. I live in the real moment, just like I drive a car in the real moment. I have to look at the chart I have. And in my mind, I will think through scenarios. What will the Fed do? What won't they do? And things like that. But there's so many variables right now with inflation, demand destruction. You're seeing a lot of commodity stocks get absolutely trashed in the process, but that's not a good sign either. So, and then if we do get this resolution in the war in Ukraine, how that plays out. I'll show you one more I've been looking at while we're here. I know we got to look at Tesla. I don't want to ignore that. But Kathy Wood's ARC, this is one I've brought out because of the counter ranges, the basing structure, all that. This is one I've actually just talked about last night with a particular group. So this one continues to get my attention. And most, these things are left for dead. They're not really left for dead. If anything, they're giving you lots of opportunities to play with the ARCs, the ARC-Fs, and what else is out there, the coins that are out there, things like this, guys. A lot of these things have bases, and people are kind of, they've been left for dead, and they're completely ignoring them, and they shouldn't be. And a lot of these have had extreme measured moves down. And so it's like they're kind of washed out. So if the sellers are done selling and, well, the buyers are showing up a little bit, just enough, it moves on them. So, even with Tesla, with its earnings and whatever, it's taking out a base structure. People can love or hate Elon, but the guy's got a lot of businesses and they all seem to have a lot of success. But if I'm being a chartist and I look at that weekly, that's a base structure. There is no clear signature on this thing. And this, again, is not buy, sell, hold advice, but it's an updraft. This is something I've taught several times at TSU. It's an updraft. If somebody's trying to short this, you're counter trend scalping right now. I mean, the chart tells you that. And this is one of the things I hammer so hard is the ability to read price over indicators. And I love indicators. Anybody that knows me knows I love them, but I also have a very massive foundation understanding price. I grew up before the internet, in case y'all don't know this. So I started the markets in '83 as a kid. I was 13. I had chart books. I didn't have, if I was lucky, a moving average printed on a piece of paper where they would send out each week set of charts in the chart books. We didn't have a whole bunch of cool fandangled indicators like we have now. Now there's more indicators than there are grains of sand, it seems like. I try to make sure you guys understand basic price structure. Fibs fits within the category of price structure framing. But a lot of people get so tied to their indicators, they miss the bigger picture of what is price telling you. Well, if price is expanding, then it can't be contracting, guys. I can't be opening my arms and pulling them at the same time. So if it's expanding, what are you thinking? Then trust what you see. If the S&P is expanding, that's sitting just off the highs of a session, then it's expanding. It's not contracting. And everybody wants to look for the boogeyman to show up, but that's not a batting average. If you look at how Josh comes at the market and Chris at the market, they're looking for a batting average. They're not trying to get the one-hit wonder. And I stress this because I watch a lot of people get hurt in the industry by trying to get that one gamble at the tables, if you will. So I hope that's helpful. I'm not sure I really answered everybody's question on that, but
I just think it's interesting that Biden gets COVID and the market rips higher. Like,
yeah, not going to comment.
Maybe, I mean,
not going to comment.
Saying, like,
not going to touch this conversation.
This is factual information.
I
Joe
agree.
Biden got COVID and the market went higher.
I will just say this. It's been a while ago, but if something, I know I'm not going to say it. I don't, we're live. It's guys, realize anybody in that regardless position, in his position, if something happens to him, it creates uncertainty, is my point. I don't wish anything ill on anybody ever. So please don't misinterpret, this, we are on YouTube Live and all that, and how the world censors crap now. I'm trying to tell you, my pro buddies, if something happens and somebody falls beyond, where we are right now, yeah, the market then has uncertainty, and the market doesn't like uncertainty, is what I'm trying to drive home. And so that I just want to leave it there, because the world we live in is so censored ridiculously now. But that's just reality, as the market would, like any other news event, except that would be a really significant event. So that's why I'm super sensitive about this. But it is in the market. The market's digesting it. But the market, Tesla, a lot of these names are moving higher. Apple's moving higher, Tech's moving higher, ARK's moving higher, and nobody believes it. But this is exactly my whole point when we did the counting ranges. People don't understand. I made the point, if we make a big range, wonderful, hopefully we'll flip the other way. If they keep them in a tight range, you guys have to batten down and hold on, because they're going to either go above the range or below the range. And if they get out of the range, you've got to run with it. And that's exactly what they're doing in a lot of cases, I know, because I'm looking at every single day. So there's kind of that. It just, he'll be okay and the markets will move forward. But I always try to address outlier potential situations, so people don't wake up one day that've never been through them and go, wait, what just happened? Why the market do this? Well, this is why. And I'm not one that likes to use the news to explain things away, but you do get black swan type events, outlier anomalies, guys. And when they happen, most people are so busy. Like, I remember 9/11. I remember watching the TV. I remember at that point, my wife calling me up and saying, there's a plane that's hit. I'm thinking, why are you calling me? Like, respectfully, I'm like, wait, what? She said, yeah. I said, a big plane or a Cessna, like a little what? I'm thinking it's just an accident. Hangs up, calls me back, say, you've got to turn on the TV. And now all of a sudden it's become very clear something's not right. And I immediately canceled. I had completely cashed out every position the day before, prior session, whatever it was. And every open position I had set to buy that day, canceled every order. Always hoping they would cancel, not knowing, because I knew the market would gap down if they opened. They didn't open the market. And all my orders did get canceled out. But those situations, we all get stuck in the deer in headlights moment. And if you ever go through one of those in the marketplace, respectfully, regardless of everything else going on and how my heart breaks for that day, you have a business. You have to refocus and go, okay, how am I going to handle whatever it is you've got going with your positions? And I was even remember being told it's un-American to short the market at that point. I won't go there. I really won't, but I just won't. But anyway, it's a sad day. But you as a trader, as a business professional, just like the first responder, you have to respond to the situation you're dealt with at that point. And if you trade long enough, guys, you'll go through it. So just for what it's worth.
Let's come back to Tesla here. I'm going to snag the screen back. And Chris, I actually want you to comment on this, because Tesla also, I didn't catch this. I mean, Tesla's a big boy stock, so you got to have a pretty good size account to be trading this. But it's either just confirmed a breakout, ironically, talking about the squeezer, or is getting ready to. So what's the protocol for trading the breakout like this? Is there a confirmation, or is it? I don't know if you saw Johnny's question. He was asking about buying calls now or wait till the next candle.
It technically hasn't broken out yet. If you look at the numbers on the right side of your screen there, the green numbers are still inside the orange numbers there. So technically it's still squeezing, but I mean, you can just look at the price action and see it's obviously going to break out outside of that. So technically, if you were going to do a squeeze, you wanted to get in while it was squeezing, and you've had a good solid 3-4 weeks there in which to build a session in Tesla. So I would say it's probably a little too late at this point. If you're trying to do the squeeze setup, if you want to do a different type of trade just on the breakout, I don't think there's anything wrong with that as long as you have a plan to go with it. I'm not a big fan of seeing this is something big. I'm gonna buy some calls and hope it keeps going up. I'm not a big fan of that. I think if you have a trading plan and this is a setup in one of your trading plans and you're following that, then I'm okay with that. As far as trading the squeeze setup specifically, I guess technically, since it hasn't fired yet, you could still get in. I would probably sell puts on this more than I would be buying calls, but I guess it just depends on what your upside target is for Tesla.
I agree 100% with that. It's really well said. And, you know, we kind of go in cycles here at TSU. To some extent, we base it on what we see you guys doing. And Chris and I were just talking yesterday about the need to have a training time on trading plans. And so keep your eyes out. That's going to be coming up probably going into the beginning of the school season when people aren't traveling so much, and we've got some opportunities to sit down and really hammer out, okay, what's our fall plan going to be? And of course, all access, you guys will have access. If you're not all access, it'll be very approachable. But so wise, Chris, don't just see the volatility and get excited, but it's got to fit into your trading plan. So I guess, Johnny, my question back to you is, does this fit your trading plan? Like what are you seeing specifically that this is a qualified trade for you?
Josh, while you're doing that, will you drop your fibs on this from the April highs somewhere up near there?
So are you looking at this?
Yep.
See, we just finished each other's Fibonacci ranges.
Mm-hmm. If y'all will look,
that was a stretch.
Yeah, I love it. If y'all will look left, guys, just kind of that Q1 of 2022, and just kind of know some reactions along that green, that bottom fib number, and just to get a feel, right? Just to let that sink in.
So I would draw. I think if I translate Scott into my language, I would say, as long as we trade to or within, but not above that red box, then I would still be requiring of myself to maintain a bearish bias on Tesla. Is that what you were thinking, Scott? Or did I put words in your mouth?
No, I'm just wanting people to be aware of kind of what you're running into here. If I was going to go a different approach with this, I say different, like not a different approach, just a targeting upside. I would put a box. Let me see your screen for 1 second, Josh, just so I can make it easier, because I don't drive you crazy with it.
You want control? Okay.
Yeah, just for a second. Just let me throw this in, could be easier in case people get questions. So when I look at targeting on this, he put the fibs in there. So I'm going to look at this as a box structure. We've taught this before. You can use the high of this and the exact low of this. A lot of times I try to shave off a little bit of these just for the initial, just to get a feel, and then just take it and stack it on top, right? Just to give a geometric progression up. Okay, where's the middle of that box? Roughly right about there. Now look at what's kind of right there where you broke down the past. So if somebody is trying to take this out of this basing structure, which it's not the most ideal base I've ever seen, but it is going to work. It's got the what I call a teardrop formation to it. So you got a fib come into play right there at the midpoint of that, but it just gives you some places if you are involved with it. They are trying to break it out. So in Johnny's case, let's say he's not involved with it. Do you really want to buy it today up, 68 points, 10%, whatever it is? Or do you want to let it pull back some and recycle on a smaller time frame and then see if you get your entry? Clearly it has momentum on the upside. We can see that. But I want to hammer this out for a minute when you guys are looking at your charts. So you don't feel like you need to chase. You should let things pull back over time and reset to a level where you want to purchase from. I think that's pretty obvious to all of you, but I watch people all the time. They see a bunch of green bars and they want to jump right in. I'm like, no, let it pull back, because if it's going to go higher, then you should be able to capitalize off the pullback, is more to my point here. And that's when Josh showed the fib, so you at least get a feel of where these zones can be inside of this, looking, over time, just to give you a feel of where you might run into some trouble here on the way up. Remember, when you go into, let's take this one out of the way. When you get into between that 38.2, 61.8, so to speak, that's what I call the fib zone, right? That is that congestion spot where you'll see stock struggle. The midpoint, that's about here. Remember, I said a zone. I didn't say penny perfect either. Okay, so that's why I'm addressing that for everybody. It's a zone, like a trampoline. You jump on the trampoline, it bounces a little bit, as opposed to I'm standing on a concrete slab with some carpet on right now. It's not going to give a whole lot. Trading, a lot of times, guys, they'll pop stops, and you'll see it play out because they know the retail typical trader is going to have really tight stops. They'll pop them, reverse them. So there's that, if that's helpful longer term for anybody.
That's very helpful. And Johnny, I saw your question. I responded in Zoom. We absolutely have a trading plans class. Alfonso has taught it. It's his genius. And we're going to refresh that. I think, man, we've got to be coming up on like the 9 or 10 year anniversary of producing that class. So we'll refresh it. The content is timeless. We'll make the slides look cool, and keep an eye out for that coming up here in the next few weeks. Triple bottom. So I don't disagree with all of these bottoming perspectives and any of that. It might be. It also might not be too. So I'm not quite ready to pull the trigger and say we are going bullish, we are going bearish. One of the ways, if you're curious about how I'm handling this personally, so a lot of you guys know I exited all my real estate. I'm not saying go sell all your real estate. I don't know that the real estate market is going to crash. I think it's cooling, but I don't know that it's going to crash. That's a whole separate conversation. But now I'm sitting on a pile of cash that I need to do something with, and cash in an inflationary world may as well just be a slow burn. Like it's not keeping up with inflation. So, depending on what your outcome is for your trading plan, one thing you can do is just commit to dollar cost averaging. Maybe we go down, like how much further would the market go down? Maybe if there's another 20% drawdown on the overall market, that's going to feel like Armageddon. And that would bottom us out around 50% total drawdown. Well, okay, if I'm going to take $1 million and divide it into tens, and I just keep buying in chunks of 10, then you're just dollar cost averaging all the way on down. And then my play, until I've got a asset that I want to reinvest in, is just covered calls. Like just let the market do what the market does and go out and write covered calls against that. And you're sure as heck going to do a lot better than letting it rot in a savings account somewhere. And then when the economy cools off, when prices come back down within the stratosphere, that's when you go buy. Like it works in real life, like in the stock market. Sell when things are high and buy when things are low. I just finished teaching a Cash in Your Jeans challenge We did not advertise it to TradeSmart. I think we're going to the next time I teach it, because candidly, it was awesome. Humbly, very, very humbly speaking, it was amazing. And, one of the things that I was talking about in there is like, you all have a garage full of crap. And if it's not in your garage, it's in your house. And if it's not in your house, it's in a storage unit. Like, I mean, we all have the stuff. We live in America, or at least a developed nation. Like, now is the time to sell that crap. Like, it's amazing. I'm selling old computers that we used at TradeSmart that are 4 or 5 years old for like half of what I bought them for after we used them for 5 or 6 years. And it's just the price of everything has gone up. So sell stuff when it gets more expensive, and put that cash in a vehicle where you can leverage it and make some money while you wait. And then it's going to get cheaper, I promise, or at least stabilize. And the earning potential will increase to meet whatever the new price tags are. And then that's when you buy. So that's my perspective on my larger non-public account. Now, if you're trading a $3,000 account like TSU, then we're just trying to grab the ebbs and flows here. But even that, and I didn't mean to go here, but this is where we've arrived. We don't exactly have a show script. It's just whatever's on our mind in the market. The way that you trade a $3,000 account is much different than the way you trade a $30,000 account, is much different than the way you trade a 6-figure or multi-6-figure trading account. The outcomes are just different. When you're at $3,000, you're trying to grow to the point where you can get to a $25,000 day trading account and do some more flexible strategies. So your trading plan changes as your account level changes. And I think that it's important to take note of where you are, where you're going, and what's working now, and then prepare for what's going to work in the future. So anyway, let me check questions. You're welcome, Johnny. And Tom, I think I addressed the triple bottom. You're not wrong in that. I mean, it's triple something. We'll see if it's a bottom or just consolidation. Hindsight's going to be the teller of that. I think I caught up on all those questions. Let me check YouTube. If you are on YouTube, there's one viewer on YouTube right now. We've had 30 people, but I guess they didn't like my Joe Biden comments. Actually, it's a pretty safe bet they did, because like only 30% are still in favor right now, according to the polls. I think everybody's like, okay, I'm not saying it's got to be a D or an R or any of that, but like, let's move on. We tried an experiment and it did not work. But if you're on YouTube, feel free to type a question in the chat, and that'll pop up and we can answer that for you. And also, it helps a lot if you guys like the video, or if you happen to have just stumbled upon us, subscribing would be great. We'll put great content in your inbox, and it'll help us get the message out to more and more people.
Real quick.
All right. Go. Yeah, I was going to say we got about 7 minutes left here. So it sounds like, Scott, you've got something on your mind.
Yeah, just really quick, guys, just to help. So concept I developed 2.5 decades ago, and I started teaching it about 20 years ago. It's called the Market Watch 4. I've probably done more on this.
This is new to me. You haven't told me about this yet. Yes. There's a whole new
of everybody. Like, oh, I feel so bad for you. Okay. Yeah, we okay. I'll do a quick, just real quick on this, and then at some point in the future TSU live we'll go through some more depth. But this is literally the first thing when I started educating people, when I got into this industry, unknowing I was going to go this route one day. This is the literally first thing I taught everybody. So it's called the Market Watch 4. It's the SPY, the QQQ, the DIA, and the IWM. That gives me a really good broad swath of broader market. And like I said, we'll go back through this in detail because of time constraints. I challenge everybody, day traders or investors and anything in between there, you should set this up and you should watch it. If you're a day trader and you're in a call room and all you guys are looking at is the Qs or the CompX, then when the divergence happens with the other three and the NASDAQ's going north and they're going south and you're blaming the market makers, it's because you don't well, respectfully, somebody didn't teach you, or whoever's running your call room doesn't really know what they're doing. Respectfully, I've seen a lot of people in call rooms who just trade go-go names, momentum names, NASDAQ names. They have no concept that this is the whole thing I always talked about. Imagine Josh, his wife, and 2 kids, and they're all holding hands and they're all walking the same direction on the beach. Then all of a sudden, Josh and the wife said, "Ooh, we're going to go the other way. Come on, kids." And the kids are still walking the direction they were going. Mom and dad turned around. They're still holding hands. They're going in a circle. If one of the 4 of these, one of the kids wants to run off on the beach, the other 3 have to go chase that child down, or the child comes back to them. That's what happens with this. You will catch so many divergences, so many heads up in real time. You do this as an investor on a daily or weekly chart, you'll start to see, you can go back and look at history and you'll see where the small caps were already flashing a problem in the economy while the other 3 were playing smoke and mirrors. So currently, why am I showing this? Because normally the small caps and the Qs team up and the S&P and the diamonds team up. Okay, well, if you look at this right now, the SPY's at the highs of the session, the diamonds are what? They're struggling at the past 2 days, and I'm saying the past 2-day highs. The Q's clearly above, and yet the small caps are struggling to even get back close, relatively speaking. Okay, so either IWM's got to get pulled up, diamonds need to go on up a little more, and the S&P and Q's keep doing their thing. If not, IWM start to roll over. The other 3 are like, where are you going? And they start to say, well, we got to pull back a minute. This is like having 4 people roped together, and as one moves, 3 are being drug, or you all move in unison. The market watch 4 this way. This is literally the first thing I taught in 2002 or 3 ever. And I have people who still, the very first students ever had, that still use this every single day of their career as active traders. As investors, you should look at this. If you've never spent the time, the same logic would work if you're going to use, say, I don't know, the futures markets for these. Okay. You could do this with 4 different pairs of currencies if you had 4 that really were the dominant markets. But more importantly is just to work with this. I've watched a lot of day trade call rooms, especially the NASDAQ type players, and everybody complains and they get stopped out. They blame the market maker, they blame the call guy, whoever it is, and they had no clue these other 3 markets impact it. You could put the MDY on here, the mid caps, but these are the 4 core staples that I use and have for over 2 decades. And it's the first time I taught anybody, and it still works today like it did then. If you've never looked at this, now use your indicator packs that you like, and then look at how these 4s are interacting. The other piece of this is if the whole 4 charts are lifting higher and you've got a proxy position that mirrors this, then why are you freaking out and getting out if the 4 major averages are pushing higher? Last thing, because we're tight on time. If these 4 charts are trying to go higher and you see a bunch of underlying heavy hitter names trying to go lower, you know they're manipulating the indexes. It's what I call a duck on a pond. Under the surface, those little legs going fast, on top everything looks good. This is that kind of, we're showing you one thing like the Ali Foreman rope-a-dope. We're showing you one thing and we're doing something else, and there's rotation under the water, and you guys will see it in your underlying names, but the averages won't reflect it. It's manipulation. Anyway, that is like, I don't know, a 5-minute intro into this. We can do lots with this. You could spend the rest of a whole year on this by yourselves and be blown away at what you would learn. And it doesn't matter if you're an investor or a day trader, just pick your time frame and look at it. It will blow your mind the value you'll get from this. And I don't say that arrogantly, I say that seriously. I have 2 monitors. I run 2 different versions of this on constantly, so I know where they are. Anyway, hope that helps.
It does help. I was looking at mine. This is weird. Hold on. Okay, disregard.
Okay.
For some reason, I was setting up my core 4, which I'll rename and trademark so that I can use this.
It's actually the Market Watch 4 officially. So,
well, I bought marketwatch4.com already. So
good. We're set then.
Oh man. Okay. So the takeaway that I wanted to kind of land that plane is when in agreement, it would offer directional insight, but when in disagreement as they are right now, it's not it's a weight. It's not it's not that we're bullish, it's not that we're bearish, it's we don't know. It may be that small cap and the Qs or I forgot which one. The Qs were breaking out. No, the small cap and the Qs were restricted, and the Dow and the S&P were breaking out. Is that what was happening?
No, the S&P and the Qs had broken out the other two. The diamonds were right close to trying to balance, and the IWMs were the weakest of the group.
Right. So that's a weight sign then, right?
It could be a weight sign, or if you're trying to push a position and you see one of these diverging, especially when you go in the deep pockets in about an hour from now when the pros close the market those last 2 hours, that IWM divergence might be a sign that things that are extended start to get pulled back. And if you're a scalper, you can leverage that opportunity. Or all of a sudden, the diamonds break out, the S&P keeps going, the NASDAQ keeps pushing, and next thing you know, the IWMs come behind it and lift. The other thing is in real rotation, you might see, say, the S&P and the diamonds stabilize and get to a level and not really just kind of range bound. And then the IWMs start breaking out and the Qs are just kind of hanging in there with them. But the IWMs become the leader and all of a sudden it goes in leadership. You'll see this with rotation. It will help you see rotation. Another way of doing this would be put like XLF, XLK, XLI, those 9 key sectors, put them on 1 or 2 screens, and you'll see sector rotation and you'll see the health or weakness of a market doing the exact same logic. You can, one more thing on this. If anybody
that I do all the time, and that's usually part of my power trader flow.
One of the things a lot of you can do, if you have 4 stocks that are similar, okay, Goldman, Morgan, JPM, and the XLF, you could look at those. Let's just do this really quick. I know we got to get out of here, but let me do this really fast. Goldman, JPM, Morgan Stanley, and XLF. I suggest as anybody, if you ever are going to try to diversify risk, let's say you wanted to own, all 4 of these, or maybe just JPM, Goldman, and Morgan. And I'm talking shorter term stuff, right? Or maybe longer term. But when you look at this, as opposed to trying to cherry pick the best of breed, you're trying to buy all 4 of these, or maybe just ignore the XLF right now and buy the other 3 and diversify your $10,000 into 3 equal portions or something like that, right? But when you look at your chart, you might notice, well, which one of these doesn't belong here? Which one's the weakest? Which one's the strongest? Relative strength is Goldman. Just look at the price relative to looking left. Then behind that's Morgan. And then JPM still down here. And the XLF's a little better than JPM probably just by looking at current price and looking left at relative high. So that gives you a looking at relative strength, relative weakness. If the IWMs, going back to that, is relative weakness against a recent high and the others are breaking out, that is a divergence. And you want to pay attention. But this is another way to take groupings, miners, rigs, whatever, and do the same analysis so that you're not so laser focused or tunnel vision on one stock, and you can look at the group as a whole without actually looking at, say, the XLF index. You could do this with Home Depot, Lowe's, Sherwin-Williams, and it will just help you see things, guys, when you're doing your homework. It's very, very constructive behavior if anybody wants to go through the time to do it. For me, the must is the SPY, the QQQ, the diamonds, IWMs as your market watch for. You really want to spend time on that. It will do a lot for you and it will keep you out of a lot of hot water. And when markets are shifting gears, you'll see it. One more thing Josh brought up. The fact that one of them is not in agreement doesn't mean you have to stand down or not do anything. It's awareness, your surroundings. You get out of your car, your wife gets out of the car at a parking lot. There's a white van next to her with blacked out Scooby-Doo type windows, right? I might be a little sketch right there, right? The same in the market. Be aware of your surroundings at all times. And this will help you do that. And those ETFs are such a broad swath. It's like, 2,500 stocks contained within that. You'll get a really healthy feel of the overall market and who's leading and who's lagging very quickly, just by looking at current price and looking left at some point of reference. Or if you're using a MACD and moving average, or you're using Fibs, if we were to do this with Fibs, and I'm going to go, if we took Fibs on a 5-minute chart, like Josh has set up on those 4 charts, and you look and it's like, crap, the small caps are, they've barely moved close to the Fib, and the other 3 above the midpoint, that would be a relative strength, relative weakness way of measuring things. It just needs to work for what you guys use. because again, 70% of your stock's movement is coming from the underlying S&P, Qs, IWMs, diamonds, from those main core markets. So why not leech onto that? Make it a habit of looking at it. You'll learn a lot from, if you'll spend the time with it. And like I said, we can come back to this in conversation at a time. That's it. I'll leave y'all alone because I know it's time.
Yeah, it is time. I just want to point this out too. And one of the reasons that it's so valuable to look at the core four trademark University. I love and appreciate you, Scott. I just pulled up, there's no filter on the scan. It's all the stocks that are available to be traded. And look at your big boys here. Look at the day that they're having in the market. And what's interesting to point out here, Tesla up 9.3% is in the S&P 500, but is not factored in to the Dow. And it can be, and it's backed off a little bit recently, but it was a major issue and continues to be an issue where you get these FANG stocks. We're gonna have to change the name because Netflix exploded and it's not a FANG anymore. But where these top 5 to 8 stocks in the S&P 500 represent the majority of the capitalization of the S&P 500, and they start pulling this index, and it's a little bit artificial. So that's why it's so wise to look at all of the indices and see what's going on. And as well as, so my thing, Scott talks about all the sectors, the XL sectors, and I've changed my strategy a little bit in the last year, but it's still largely the same. And the reason I had to change is because the crash came, the 2022 pivot. But it used to be, as long as the market direction momentum, the sector direction momentum, and the stock sector, or the stock direction and momentum, if those were in agreement, that was the green light for me, or part of the green light. But if they start disagreeing, so the sector and the stock are going down, but the market's going up, then it was cause for pause. And it used to be very dogmatic that they had to all be in agreement, and then I had to relax that a little bit, especially when you consider strategies like the Morning Glory. It's not always possible. It's such a fast trade. It's not possible to have everything lined up. But anyway,
let me show my screen one more time real quick. Sorry, before we wrap up, just because of what he brought up, this is a great example of what you can go do right now if anybody wants to do this. And again, it depends on your time frame. There are those 5 key stocks. I didn't put the GOOG, I did the GOGL. Now look at this really quick. Look at the current price relative to the most recent high you can see. Well, Tesla's clearly blown that out. Amazon's creeping through it. Look at where Google is, though. Look at where Microsoft is, matching that 2-day high, but yet Apple's above it. So what's wrong with Google? And I don't say that like I care. I'm saying from a standpoint of evaluation, just like that, you can figure out where relative strength, relative weakness is. The strength is Tesla on the left, clearly, because it's blowing everything else out. Now look at Google. Well, could Google struggle up here and start to bring the market back? I don't know. What's its waiting? Again, thank you, Google. I call for you. My phone picked up seeing me say Google like that. Never fear. It just did it again. Anyway, but you get my gist with this. It's
You'll have
like,
to call it alphabet.
Oh God. So, but this is a quick way to look at this. And if those are your leadership names, regardless of time frame you're trading or investing in, it's a quick way to look for trouble. Just look at current bar relative to the high or the low, depending if we're selling up or down, whatever it is. And guys, you can just like that get a really quick feel. Notice this pure price. I've got no indicators on these. I'm just looking at current price, looking left. And I'm looking at recent highs or recent lows, depending on what direction we be going in. And now you could do some Fib analysis. Hey, if Tesla pulls back, where's the 50 Fib retracement on this? Are we at a Fib retracement right now of Google from that high to that low? Well, everybody else is above it. So you have Apple leading, Tesla leading, Amazon dragging behind that, Microsoft kind of iffy against the 2-day high, and then Google's not. So if the market's in trouble later on, where should we look for the trouble to show up from? Probably the top 2 right charts, maybe. And I'm not saying that's what's going to happen. I'm trying to tell you how to look at a chart in the real time and just see price and evaluate it with no other tools. It keeps your bias out of it just by taking the current value and looking left. Price has memory. All right, I'm done. Sorry. Hope it
I
helps.
think it's a good place to leave it as well. Really great place. Great show today. And I know, Chris Burgess, you've been fighting internet challenges all day. So, but I appreciate you jumping in and sharing with us as well about the squeezer. Do like and subscribe on the YouTube. And if you're part of our all access community, do come and join us each Thursday at noon Eastern. We preference and bias towards the questions from our all access community. We're so grateful for you guys, and we want to make sure we're serving you at the highest level. Keep your eyes posted if you're interested in that Cash in Your Jeans challenge. It's going to be coming up in a couple of weeks. It's a free thing. And then also keep your eyes posted for some information on I'll say this. It's not what you think it is, but in full integrity, TradeSmart's about to have an IPO, but it doesn't stand for initial public offering. I'll never go public, but that seems like too much stress to me. But keep your eyes posted for some details about the TSU IPO. It's going to be some super cool training that we do going into the new school year, going into the fall, and getting ready to take advantage of all these opportunities that the market's created for us. So blessings, everybody. I hope you use this information to put fat stacks of cash in your jeans, because when good people have more money, they are able to do even more good things. So go out, do good, and do well. Blessings, everybody.